This isn't the first time you've heard me in the last decade say we need regime change at the Fed. It's not just about a person. It's about an approach to economics. It's about approach to what they're doing. And I'm troubled when I see them moving the goalposts.
And look, on April 1st, a new banking rule takes effect that turns your savings account into a funding source for the national debt. 3 federal agencies, they have already signed off on it. $210 billion in bank capital, it just got freed up. And the whole point is to make it easier for your bank to buy government bonds instead of paying you a competitive rate. Nobody on the evening news has even mentioned it. But if you have a savings account, a mortgage, or equity in a house, you are part of this whether you know it or not, whether you like it or not. And here's how the math already works against you. If you have $200,000 sitting in a bank account right now, your bank paid you about $800 last year in interest. But inflation took nearly $5,000 in purchasing power right out of your pocket. You lost over $4,000 for doing exactly what you were told was safe. And whether that was designed or not, the effect is the same, doesn't matter. So let's start here. Open your bank app and find your savings interest rate, the APY, and that is what your bank actually pays you each year. Now subtract 2.4, that is today's inflation rate, and if that number is negative, you are functionally subsidizing the United States Treasury. There's no bill there, no permission, it's just math. Now, here's what nobody's telling you. The man Trump nominated to run the Federal Reserve and the current Treasury Secretary both come out of the same hedge fund billionaire's orbit. They share a mentor, a worldview, and a plan. And that April 1st rule I just told you about is only one piece of it. You see, the man Trump nominated to run the Federal Reserve is Kevin Warsh. The Treasury Secretary coordinating with him is Scott Bessent. They both come out of Stanley Druckenmiller's orbit, one of the most successful traders alive. They share a mentor, this worldview I told you about, and a Rolodex. And they are building something called a new accord. Basically, a new agreement between the Federal Reserve, which controls interest rates, and the Treasury, which borrows the money. The last time Washington had an arrangement like that, 1942, and savers lost to inflation for years. So here's what Warsh said on CNBC on July 17th of last year. Quote, "We need a new Treasury-Fed accord like we did in 1951 after another period where we built up our nation's debt and we were stuck with a central bank that was working at cross purposes with the Treasury." Now pay attention to what he is actually invoking. You see, the 1951 accord was when the Fed broke free from the Treasury. That was the good event. From 1942 to 1951, the Fed was handcuffed, rates were capped, inflation ran, and savers got crushed. Warsh says he wants a new accord like 51. But listen to what he is actually describing. It's not independence, it's coordination. This is not the Federal Reserve being incompetent. This is Trump's Fed nominee and his Treasury Secretary doing what the incentives demand when you're sitting on $39 trillion in national debt. They need cheap money, and they need you to provide it. Now here's what that $39 trillion looks like at your kitchen table. It's about $288,000 per household. And it grew by over $16,000 in just the last 12 months. Nearly $1,400 a month tacked onto your tab. And you got nothing for it. Interest on that debt hit nearly $1 trillion last year. That tripled since 2020. Interest is now one of the 3 largest line items in the entire federal budget, right behind Social Security and Medicare. Since 2020, property tax bills have risen sharply in many local markets. Insurance premiums climbed over 20%. Grocery costs up more than 25%. Your savings account, according to the FDIC, is paying you 0.39% on average. And they tell you inflation is under control. $100,000 in cash has lost roughly a third of its value since 2010. The same money in gold actually grew 130%, which is why I put a dealer vetting checklist for you at hedgethefed.com, because the wrong gold dealer will rob you faster than inflation will. Now, I'm just a guy who buys houses for a living. I do not have a PhD in monetary policy, but I can do subtraction. And when I subtract my savings rate from the inflation rate and get a negative number, I don't need that PhD to know someone's hand is in my pocket. And if you think this only hits your savings account, it does not stop there. The same restructuring that kills your deposit rate is about to push 30-year mortgage rates in the wrong direction. If you're buying, selling, refinancing, or sitting on equity in a paid-off house, this is coming for all of it. Have you heard of a linguistic autopsy? That's when you take what someone said and translate it to what they actually meant. Warsh went on Fox Business last summer and said, quote,
Well, if you look right now, and you could take down that balance sheet $2 trillion over time in concert with the Treasury Secretary, that's a big rate cut that could come. And what you would do then is turbocharge the real economy.
Here's what that means for you. There are two rates that matter. The short-term rate, that is your credit cards and your savings account. And the long-term rate, that is your mortgage. Warsh is cutting the short one. That is his big rate cut. That is what makes the headline. But when the Fed dumps its long-term bonds to do that, the long-term rate, where your mortgage lives, that goes up because the Fed just stopped being the biggest buyer in the room. So the evening news says Fed cuts rates. Your credit card rate might drop, but your mortgage rate, your refi rate, those could climb. And he's calling it a rate cut. It is a rate cut for the short end. It is a rate cut for the government, not for your house. That's what they serve you on the surface, but they bury the real machinery under language designed to put you to sleep. They call it the Enhanced Supplementary Leverage Ratio reform. Enhanced Supplementary Leverage Ratio. That sounds like a vitamin supplement for your transmission. Here's what it actually does. It lowers the capital requirements for the 8 biggest banks in America, which frees up roughly $210 billion. And the rule was built specifically to make it easier and more profitable for those banks to hold government debt rather than compete for your savings. They're there to hold government debt now. And 3 federal agencies, the Fed, the OCC, and the FDIC, finalized this rule together November 25th, 2025. And it goes live April 1st this year. I mean, we're like a week away. So when your bank has a regulator-approved, risk-free way to earn 3.35% on treasuries, they do not need to pay you 4% on your savings. Financial analysts are already warning that this rule makes banks want to buy government bonds instead of lending money to regular people. Your savings yield drops. The government gets its debt funded. Wall Street gets its risk-free return. And you get the bill through an interest rate that lags behind inflation. It is a gift to Wall Street, dressed up as a safety reform. Now let me show you why this matters so much with something you'll never forget. Think of this like a toll road. The government needs to pay off the construction debt it took to build the road. But instead of raising the toll, they just stop filling the potholes. The toll stays the same, but the road gets worse. Your tires wear out. Your car needs new shocks. You are still paying, but you're getting less in return. That is financial repression, when the government uses rules and inflation to shrink its debt without ever raising your taxes. The toll is your savings rate. The road is what your money can buy, the devalued dollar. And they already ran this play. From 1942 to 1951, the government capped what your savings could earn so it could borrow cheaply to pay off World War II debt. And even after that cap ended, inflation kept running. A 2024 IMF study found the government did not grow its way out of that debt. It inflated its way out. And savers paid the bill for decades without ever seeing a tax increase. The rule is real. The quotes are real. The history is real. My read where it leads is actually where the debate starts. And if noticing that your bank statement does not match what they are telling you on TV makes me some sort of conspiracy theorist, well, fine, I guess that's what I am. I'd rather be that with a full bank account than a compliant citizen who goes broke following the rules. They are counting on you not reading the fine print. Bad bet, because you've been reading fine print since before these people were born. I mean, if you're over 50, you have lived through enough of these economic cycles to know when the math does not add up. And here's the question nobody on financial television is asking. If this new banking rule is so good for consumers, why did gold sell off sharply and the dollar rally the day Warsh was nominated, while your savings rate sat right where it was? Because Wall Street knows this rule gives them a guaranteed return at your expense. That is the unasked question. And I'm not here to scare you. I'm here to make sure you see what is coming before it hits. Because once you see the machinery, You can then build your fortress with confidence. You have a very specific set of skills. You've been paying attention, doing the reading, and checking the documents, and now it would be a good time to act. And listen, I'm not your attorney or your CPA. There's nuance to this. I mean, every situation is different. What I'm about to lay out here, it's a framework, not a prescription. Here's what to do today. Move your cash to a savings account that actually pays a real rate, 4% or more. You can do it on your phone in 10 minutes. I found a decent one a while back, and it's still above 4% right now, barely. And I'll put the link at the top of the description below. And if you use that link, we both get an extra 0.5%. I think it might be 0.75%. See, on $200,000, that is the difference between earning $800 a year and $8,000 a year. That alone nearly closes the inflation gap. So check it quarterly because banks are quietly dropping rates. So if yours falls below 3.5%, you got to move. You got to look for someplace else. All right. So here's what to do this week. If you have a mortgage, stop spending extra money each month to pay down a fixed rate mortgage below 5%. Every extra dollar you throw at a 3% mortgage is a dollar not going into something that keeps pace with inflation. The United States government borrows at over 3% and counts on inflation to shrink that debt. If it is good enough for the Treasury strategy, why would you do the opposite? That is inflation arbitrage, borrowing at a low fixed rate while inflation makes that debt cheaper over time. The government does it. The 1% does it. And now you know it has a name. And before you say, I'm not a billionaire, you don't need to be. You just need a fixed rate mortgage and a savings account that pays more than inflation. That is the whole move. Take that extra payment money and build a war chest. Consider establishing a home equity line of credit while rates are still reasonable. You know, not everyone, it's going to depend on your situation, but a line of credit established now costs nothing until you use it, if you ever do. And I'll put a link to my people below for that as well. This gives you liquidity, access to cash when you need it, without having to sell something at the wrong time. And if you have significant equity trapped in the walls of a paid-off house earning 0% while inflation runs at 2.4 and climbing, that is frozen capital. It's retired money. You've retired your money before you retired yourself. And in 17 years of real estate, here's the one thing that I tell every homeowner in this position. Your home does not send you a check every month. Someone else's does. Active defense means your assets are working, not sleeping. Pull your most recent mortgage statement tonight. Circle your interest rate in red ink if it is below 5%. That is an asset. Do not let anyone convince you it is a liability. Everything that I've shown you so far is on the public record. What's not public record, we have to do our best to connect the dots. And here's where I think this goes. The new accord takes shape over the next 12 to 18 months. Short rates fall, long rates rise. Banks become the government's captive buyers. And the person holding cash at 0.39% becomes the quiet tax base that services $1 trillion in annual interest without ever receiving a bill for it. The government will not formally default. They will not announce a tax hike on the middle class. Instead, they will let inflation run just hot enough to melt away the real value of their debt, while using bank regulations to steer your savings into low-yielding accounts. But you are not most people. You are the type of person who does not wait to get blindsided. You read the document, you check the numbers, you make the move. The new eSLR banking rule already finalized by regulators, the new accord being negotiated in public, and the balance sheet restructuring being modeled on Wall Street. These are not separate events. They are three parts of a single machine designed to shift the cost of $39 trillion in debt from taxpayers to savers. And the machine switches on April 1st. Now here's the part that keeps me up at night. I just showed you the machine. I showed you the players, the rule, the history, the playbook, but I did not show you your number. How much purchasing power have you already lost sitting in cash? And how much more are you going to lose over the next 5 years if nothing changes? Because that number is specific. It's not theoretical. It's not macro. It's yours. And it is probably worse than you think. It is for most people. So I went and I pulled this video out here for you to watch next to lead you to a calculator that I built that takes your actual savings balance and shows you exactly what inflation has already taken and what it is on track to take next. It also walks you through the playbook for stopping the bleeding, step by step, with a free guide you can download in 60 seconds. So watch this next. God loves you, and so do I. Take care.